Stone Creamery is the direct result of two ice cream lovers' quest for the perfect ice cream dessert. In order to meet their personal standards of quality, flavor, consistency, and variety, Donald and Susan Sutherland opened the first Cold Stone Creamery in Tempe, Arizona in 1988. There, customers were first treated to what would become the Cold Stone experience. Today, Cold Stone has over 1,300 stores in the U.S., Puerto Rico, Guam, and Japan. Another 1,000 franchises are being developed. But at every store, in every city, in every country, in every culture, the Cold Stone experience is the same. It has to be the same because that is the experience associated with the brand. That's the brand's marketplace power, and that's how the brand is priced.
Thanks very much.
16 basic flavors, 30 added ingredients, 3 sizes. At first glance, it may not seem that Cold Stone Creamery presents much of a challenge when it comes to costing, but it is in fact the mastery of that particular challenge which has enabled Cold Stone to become one of the most profitable and fastest growing franchises in America. Cold Stone Creamery applied the principles of activity-based costing to develop the cost structure for all its products. Activity-based costing, or ABC, considers costs directly associated with the production of a product. Every customer who enters a Cold Stone store gets the same friendly greeting, the same menu choices, and the same live entertainment.
We got some fun, our song is done.
Where the customer experience differs is in product selection. The size of the product, the variety of ingredients, and the time associated with product preparation are all activity-based and are reflected in the price paid at the cash register, as well as the individual stores and the company's profit.
One thing that was instrumental in our success was we actually developed an activity-based costing analysis. As we look across the stores at all the different products that we offer, what differentiates them other than the taste is the ingredients that we put in and the time it takes to make it. So we can go into each store and truly assess what the business means to them, meaning that it costs them $1 to make a batch of ice cream, or it costs them 25 cents to produce a Love-It creation. Obviously, we have to take into consideration other overhead expenses, and how we decide to allocate that into the cost is important not only to us, but the franchisee. I think it only makes sense to have the price of a product reflect all of the activities that go into making the item for the customer.
The ABC approach also makes sense to Cold Stone Creamery franchisees. Like everyone else in the food service business, the stores work on tight margins. They don't have room for wasted time, wasted energy, or wasted ingredients. Owners and managers know exactly how long service should take and the quantity of ingredients that will be consumed in a particular product. They know what the profit margins are on each product and what kind of financial goals they are expected to reach based on those margins. If they are not making their margins, they know to look at the activity involved in creating the products and fine-tune that activity. They also know that Cold Stone Creamery has the benefit of years of experience at multiple locations. That means they have gathered a large statistical database on which to base their financial decisions.
I think one of the benefits of being the size that we are and having the data that we've collected is it gives us the ability to drill down into a region and into a store to understand the decisions that we're making at a corporate level, how that's going to impact that franchisee. The more data that we're able to collect, again, the more we can stratify and again make better educated decisions.
Cold Stone Creamery customers have a lot of choices. Certainly, the number of different types of ice cream and the mix-ins are reflected in the purchase price. Another significant part of that price is labor, the activity involved in creating the product. These frosty confections come in 3 sizes: like it, love it, and gotta have it. The difference in preparation time for these treats can be measured in seconds. But it is because Cold Stone took the time to calculate the costs associated with those seconds that they can accurately identify and define those activities directly associated with the creation of specific products. They can work within the tight margins associated with their industry and still generate the kind of profit that keeps future franchisees standing in line, waiting to take advantage of the opportunity.
Obviously, when you're dealing with activity-based costing, the first thing you're going to do is make a list of what those sub-activities are, and then you're going to assign a cost to it. The three preparation fields that we deal with are the ice cream, the waffle cones, and the mix-ins. The cost of preparing a batch of ice cream is approximately $1. The cost of preparing a mix-in is approximately 3 cents, and the cost of preparing a waffle cone is approximately 6 cents. Next, we go into the guest interaction. Again, our service is second to none throughout the country, especially in the ice cream industry. So it's important that we get that guest interaction, that we're greeting the guests when they come through the door, that we're giving them a sample of our ice cream, getting to know them and understanding what's going to satisfy them the most by leaving with the creation of their choice. Then we move into the production, which is actually making the like it, love it, gotta have it creation, specially made for them. Typically, the cost of making that creation is going to be about 25% that we allocate. And then the next is the point of sale process. We're going to ring them up in the register, make sure we capture our cash, bid them a farewell, and hope that they come back.
After more than a decade of franchising, Cold Stone Creamery knows what it costs to run their stores. The costs for power and raw product, the costs for filling the product bins and the cash register, the costs for napkins and spoons and cups and garbage can liners are spread out across the entire product line. Every store must have a host, at least one person working a cash register, and at least 3 people creating product. Again, these are overhead costs associated with all their products.
When it comes to activity-based costing, we need to look a lot more than just at the hourly wage. We need to take into consideration all of the owner's other expenses when it comes to that, including training, uniform costs, benefits, etc. So being a part of the profitability team, we truly are globally looking at the entire business and making our decisions based on our findings.